Welcome back to the channel where we break down high yield ETFs for your portfolio. Today we're pitting two NASDAQ 100 covered call beasts against each other. One for steady monthly income with growth potential, the other for sky high weekly payouts. We'll cover the positives, negatives, exact distribution amounts, and declare a winner for your passive income strategy. If you're building cash flow without killing upside, this battle changes everything. Let's dive right in. First, let me introduce myself. My name is Wes, and for the last 3.5 years, I've been researching ways to make passive income in both the stock market and in cryptocurrency, and want to bring my results, whether good or bad, to you through this channel. If that sounds good to you, make sure you subscribe to the channel and drop a like on this video. I would greatly appreciate it. Okay, let's start with TDAQ. This is a steady income play that launched in late 2024. TDAQ targets NASDAQ 100 growth with daily 0 DTE covered calls on QQQ for smooth monthly income. Over the trailing 12 months, it dished out $1.13 per share. That's roughly 37 cents monthly lately, with yields advertised around 17%, but trailing closer to 4 to 10% on the current NAV, which is the net asset value. Okay, let's concentrate on the positives first. The positives are that it's a reliable daily option for premiums and delivers consistent cash flow even in flat markets, plus some capital appreciation when NASDAQ rallies since calls aren't too tight. Lower NAV erosion risk compared to aggressive peers, actively managed for tech innovation focus, and perfect for retirement buckets wanting daily income potential without wild swings. And it does have a total expense ratio at 0.68% currently. Okay, here are the negatives. The upside gets capped on the big up days from the sold calls. The expense ratio is a little higher than the regular QQQ. Zero DTE options amp volatility in choppy times, and it does have a tiny assets under management of only 20 to 25 million, which means wider spreads and liquidity worries. Okay, so who is TDAQ's opponent? It is the QQQY. Its Defiance's QQQY revamped post-2025 reverse split sells daily call spreads on the NASDAQ 100 for weekly payouts targeting 30% plus yields. The trailing 12-month distribution crushed $10.50 per share, averaging 14 to 19 cents weekly recently, but 100% return of capital flags sustainability issues, pushing trailing yield to a blistering 44%. What are the strengths of QQQY? Well, the weekly cash hits your account like clockwork. It's ideal for covering bills or reinvesting. You have long exposure to NASDAQ because of swaps and ETFs, which will keep growth alive. And they ditched the risky zero DTE strategy for safer spreads. It's boosting assets under management of $204 million. Okay, what are the downsides? Well, the downsides are long-term. NAV erosion chews the principal relentlessly, even after the fixes. Total returns trail plain NASDAQ by almost double digits annually, and it's over 1% in fees, which compound the decay. Yields plummet in bear markets, and heavy ROC means you're often just getting your own money back. Okay, I did a price comparison on Seeking Alpha for the two funds. TDAQ is the blue and QQQY is the orange. Obviously, TDAQ's return has been higher. It's been 2.95% over that period, and QQQY is negative 10.64%. The difference is the dividend yield. The yield for TDAQ is 5.92%, where the dividend yield for QQQY is 43.45%. If we look at a 1 month chart, it looks like the price action is very similar now. TDAQ is down 2.17%, and QQQY is down 2.91%. In this instance, I would definitely rather have QQQY because of the bigger distribution compared to TDAQ. TDAQ definitely edges out QQQY for balanced portfolios. Think 10 to 15% total return with income. And QQQY tempts aggressive traders for short-term yield grabs or income. TDAQ definitely wins on sustainability. And if you pair TDAQ with plain QQQ, you can get the full upside. Use QQQY for income boosts to pay down your margin balances. Here's a different chart comparison between the two. The ones with the red and green candles, that's QQQY, and TDAQ is the blue line. TDAQ in this amount of time is, this is on the 4-hour chart, is up 3.31%, whereas QQQY is down 6.75%. So if you take the higher distribution rate of QQQY versus TDAQ, you can see that it's going to come down with NAV erosion, but at the same time, you're getting a higher distribution. If you compare the two with the estimated total return over the last 3 months, TDAQ has returned close to 6%, and QQQY has returned close to 7% higher. It's higher due to the yield and the distributions that you get. So it's definitely for investors that want more income. If you're longer term, I would go with TDAQ. Please leave in the comments which ETF you want me to cover in the future. I want to cover them all to see which is the best for you and myself going forward. Please like, subscribe, and we'll see you in the next video. Have a great day.